Before we begin, let me ask you something important. What if one quiet decision inside the Federal Reserve just changed the entire structure of how money works in the United States, and almost no one explained it clearly? Not the major financial networks, not the loud voices on social media arguing whether gold is going to explode higher or collapse into a bubble. Most of that noise misses the real point. What you are about to hear is not speculation, and it is not built on hope, fear, or a line drawn on a chart. It is a sequence of real events that can be verified, events taking place inside the Federal Reserve right now. And if you own gold, silver, stocks, bonds, a retirement account, or even a home priced in dollars, this matters to you more than you might think. Many investors have been confused about gold recently. The Federal Reserve says one thing publicly, yet gold continues to move in ways that seem disconnected from those statements. If you have felt that confusion, this explanation will clarify it completely. The reason is surprisingly simple once you see it clearly. What the Federal Reserve just did is not only about gold prices. It changes the underlying framework that determines how money flows through the system. And once you understand the mechanism behind it, you will probably start looking at your portfolio very differently from today forward. Over the next several minutes, I want to walk you through this carefully. First, we will look at what the Federal Reserve actually did and why it stands out as historically unusual. Then we will examine the chain reaction it creates for gold, silver, and assets priced in dollars. Finally, we will discuss where this path leads and how to think about positioning yourself as events unfold. But before we get there, we need to start with the decision that triggered all of this. In December of last year, the Federal Reserve quietly announced that it would begin purchasing $40 billion in Treasury bills every month. The wording they used was careful. They did not describe it as printing money. Instead, they called it reserve management purchases. That phrase sounds technical and harmless, almost like a routine adjustment inside a large institution. But if you translate it into plain language, the meaning becomes much clearer. The Federal Reserve is creating new money and using that money to purchase government debt. That is effectively the definition of money creation. Adding the phrase reserve management does not change what the process does. It simply makes it sound less dramatic when presented to the public. This matters because for several years leading up to this decision, the Federal Reserve was telling the financial world something very different. Between 2022 and 2025, officials repeatedly emphasized that they were tightening financial conditions. They said their priority was fighting inflation. Interest rates were raised at the fastest pace seen in decades, and the central bank worked to reduce the size of its balance sheet. It was described as one of the most aggressive tightening cycles in modern financial history. Then, without a large announcement or major media attention, the direction quietly began shifting again. And this shift did not happen because inflation had completely disappeared or because the economy suddenly became strong enough to support the change without risk. The deeper reason lies in the mathematics of the United States debt situation. Once you look at those numbers closely, you begin to understand why the Federal Reserve had limited options available. Right now, the United States is refinancing somewhere between $9 and $12 trillion in federal debt during this fiscal year alone. That debt must be rolled over at interest rates roughly between 4 and 5%. As a result, the annual cost of simply paying interest on national debt has already crossed $1 trillion. Think about that carefully. That is more money than the country spends on its entire defense budget, and it is being used only to service past borrowing. Meanwhile, total federal debt has climbed to around $36 trillion and continues to rise. At the same time, the Federal Reserve itself has reported about $245 billion in cumulative losses since 2022. For many people, that raises an obvious question. How can a central bank that has the power to create money still report losses? The explanation comes from decisions made after the financial crisis of 2008. The Federal Reserve began paying interest to commercial banks for reserves those banks keep parked at the Fed. Today, those payments occur at rates above 4%. But the government bonds the Fed purchased earlier, especially during the pandemic period, often pay far lower returns. So the situation becomes unusual. The central bank is paying banks a higher interest rate than it earns on many of the assets it holds. In financial terms, that is known as negative carry. For a normal institution, running a trade like that on a massive scale would eventually lead to serious trouble. The Federal Reserve solved this problem through accounting by labeling the losses as something called a deferred asset. In simple terms, it means acknowledging that the balance sheet shows losses while also maintaining the authority to redefine how those losses are handled. Then, alongside this accounting solution, the Fed started those monthly reserve management purchases, creating money to buy debt and maintain liquidity in the system. And this is the key moment. Not because gold instantly jumps in price the same day, but because the foundation that determines how gold is valued has quietly shifted. When markets fully understand that shift, gold responds to it. To see why this moment is unusual, you have to step back from headlines and look at the data instead. People who have spent decades inside institutional finance often repeat the same lesson. News reports tend to describe what has already happened. Data shows where money is moving right now, and the data today is telling a very specific story. Gold has been climbing in one of the strongest upward trends seen in the modern era. This is not a small rally driven by retail enthusiasm or online speculation. The buyers pushing this move include some of the largest and most sophisticated institutions in the global financial system. And when you follow that trail carefully, the picture becomes even more revealing. When you follow the actual data instead of the headlines, something very interesting becomes clear. Gold has not just been rising quietly, it has been moving through one of the strongest sustained advances in modern financial history. This is not the kind of move that typically comes from small investors or short-term speculation. The force behind it has been far larger and far more deliberate. The buyers driving this trend are some of the most powerful institutions in the global financial system, and their actions tell us much more about what is happening beneath the surface than any daily price chart. Over the last 3 years, central banks around the world have purchased more than 1,000 tons of gold each year. That is roughly double the historical average. And it is important to understand who these buyers are. These are not individual traders reacting to headlines. These are sovereign nations and major financial authorities making long-term strategic decisions about how they store wealth and protect their reserves. When institutions at that level start moving in the same direction, it usually reflects a shift in how they see the future of the monetary system. The turning point that triggered this behavior can be traced back to early 2022. In February of that year, the United States and its allies made a decision that changed how many countries think about financial security. Russian foreign currency reserves held in Western financial institutions were frozen. Approximately $300 billion in assets were suddenly locked by a political decision. The event did not produce loud reactions in public markets at the time, but inside government offices and central banks across the world, the message was understood immediately. Countries that were not close allies of the United States began asking a simple question behind closed doors. If reserves belonging to one nation could be frozen that quickly, could the same thing happen to them in the future? For decades, the U.S. dollar had been treated as the most reliable reserve asset in the world, but that moment forced many governments to reconsider whether the dollar was still neutral in a geopolitical sense. Once that question appeared, the search for an alternative began quietly. There is only one major reserve asset that exists completely outside the control of any single government. That asset is physical gold. Unlike bank deposits, foreign bonds, or currency reserves held inside another country's financial system, physical gold cannot be frozen by a sanction order. It does not depend on the policies of another nation. Because of that, central banks began slowly adjusting their portfolios. This is where what we can call the first phase of the current gold cycle began, and interestingly, we are still inside that phase right now. Phase 1 is not dramatic. It is not chaotic. In fact, from the outside, it often looks calm. It is the stage where the most sophisticated players move first, quietly shifting positions before the wider market fully notices what is happening. During this phase, central banks and sovereign wealth funds gradually increase their gold holdings while reducing exposure to assets tied directly to the dollar system. They do it carefully. They do not want to move prices too aggressively because large moves would make their own purchases more expensive. They also do not want to create panic that could disrupt financial markets before they finish repositioning. So they walk slowly toward the exit while the room still appears calm to everyone else. From the perspective of an average investor watching the price chart, phase one can look confusing. Gold seems to rise steadily, but the reasons are not obvious. There is no major crisis dominating the headlines. Banks are not collapsing on a large scale. Corporate bankruptcies are not spreading across the economy. The Treasury market has not broken down, and the Federal Reserve is not yet openly buying government debt in massive emergency operations. Everything still appears relatively stable on the surface. But that calm appearance is exactly what phase one normally looks like. The absence of a visible crisis does not mean the underlying pressures are not forming. In fact, it often means the earliest stage is unfolding right in front of us. This stage is important because it is the period when large institutions can position themselves at reasonable prices before public attention arrives. Many retail investors misunderstand this stage because they are waiting for dramatic signals. They expect a financial event that clearly announces a new trend. When that event does not appear immediately, they assume nothing major is happening. Meanwhile, the institutions that manage trillions of dollars are quietly preparing for what they believe comes next. And this is where the recent actions by the Federal Reserve begin to matter even more. Those reserve management purchases we discussed earlier are not just a technical adjustment. They are a signal that something deeper is starting to form beneath the surface. In many ways, they represent the first visible sign that the market could be moving toward the second phase of this cycle. Phase two is where the situation becomes far more serious because it changes how investors view the Federal Reserve itself. Up to this point, markets generally believe that the central bank is choosing its policies from a position of control. But phase two begins when that perception starts to shift. It begins when investors realize the Federal Reserve may not be printing money simply because it wants to stimulate the economy. Instead, it may be doing so because it has no alternative left. That difference is extremely important. A central bank that chooses to expand the money supply can still maintain credibility. Investors believe it has options and is acting strategically. But a central bank that is forced to create money in order to prevent the bond market from breaking loses something much more valuable than policy flexibility. It begins to lose trust. And once markets start questioning whether the central bank is truly in control, the behavior of investors can change very quickly. To understand why the Federal Reserve may be moving closer to that situation, we need to look at the pressures building inside the system right now. That is where the next part of this story begins. To understand why the Federal Reserve could soon find itself in that position, we need to look closely at the pressures building inside the system today. These pressures are not theoretical. They come directly from the structure of the debt market and the choices policymakers will be forced to make in the near future. Recently, Kevin Walsh, who has been nominated as a future Federal Reserve chair, spoke publicly about the direction he believes policy should take. He mentioned two goals that sound reasonable to most people listening. First, he wants lower interest rates. Second, he wants a smaller Federal Reserve balance sheet. On the surface, those goals seem responsible and even reassuring. Lower rates can support borrowers and economic growth. A smaller balance sheet suggests less intervention in markets and a return to more traditional monetary discipline. But when you examine the current debt situation in the United States, a problem becomes obvious. Under present conditions, those two goals are extremely difficult to achieve at the same time. In fact, They may be mathematically incompatible. Over the next year, between $10 and $12 trillion worth of government bonds will mature and need to be refinanced. That means the U.S. Treasury must issue an enormous amount of new debt to replace the old debt that is coming due. Now consider what happens if the Federal Reserve steps back from buying those bonds as part of shrinking its balance sheet. If the Fed reduces its participation in the bond market while also trying to keep interest rates low, the question becomes simple but critical. Who will buy all of that new government debt? The banking system is already dealing with its own pressures, which is one reason the Federal Reserve began those reserve management purchases we discussed earlier. Those operations are designed to keep liquidity flowing through the system. At the same time, foreign central banks and large global investors are not buying U.S. Treasury bonds at the same pace they did years ago. Demand has weakened compared with the past. As a result, the pool of buyers capable of absorbing massive new bond issuance is smaller than it once was. This creates a difficult choice for the next Federal Reserve leadership, just as it has for many central bankers before them. The choice is not really between discipline and expansion. The real choice often becomes whether to allow the bond market to struggle under the weight of new supply or to step in and purchase that debt using newly created money. History shows that central banks consistently choose the second option when the stakes become high enough. Not because policymakers necessarily prefer it, but because the alternative can lead to immediate financial instability. There is a good example of this pattern from recent history. Years ago, Jerome Powell himself expressed skepticism about large-scale money creation programs like quantitative easing. In one speech, he explained that markets tend to demand more stimulus once they become accustomed to it, and that satisfying those expectations could become difficult. Yet in 2020, during the pandemic crisis, the Federal Reserve expanded the money supply at a speed and scale never seen before in modern currency history. The reason was simple. The alternative would have risked a much deeper financial collapse. This pattern appears again and again because when a system reaches a certain level of debt and complexity, policymakers often find themselves responding to circumstances rather than shaping them. That moment, when markets realize the central bank is reacting instead of directing events, is when Phase 2 begins. Phase 2 is the stage where investors start adjusting their expectations. They begin to understand that the Federal Reserve may not be able to maintain tight control over inflation, interest rates, and the bond market at the same time. And when that realization spreads, assets that protect against currency weakness or monetary instability suddenly become more attractive. That is when gold moves from something many investors consider optional to something they begin to view as necessary protection. This shift is not just a theory. Similar transitions have happened repeatedly during major monetary changes over the last half-century. Each time, the details were slightly different, but the underlying pattern remained consistent. When confidence in a central bank's control weakens, investors search for assets that exist outside the system that is under pressure. But there is another factor developing right now that could accelerate this entire process much faster than many people expect. Historically, certain events have acted as catalysts that compress what might have been a gradual financial shift into a much more rapid one. One of the most powerful catalysts in that category has been disruptions in global oil markets. Oil shocks have played a major role in financial history because of the way energy costs affect almost every part of the economy. When oil prices rise sharply, the impact spreads quickly into transportation, manufacturing, food production, and consumer prices. Inflation becomes more difficult to control, and central banks face an even more complicated balancing act between fighting rising prices and supporting economic growth. There is a long and clear historical pattern linking major oil disruptions with large moves in gold. In 1973, when the OPEC embargo caused oil prices to surge dramatically, gold rose nearly 90% within a year. A few years later, During the Iranian Revolution in 1979, oil prices more than doubled again, and gold climbed close to 150% over a similar period before reaching a historic peak. Even smaller geopolitical disruptions have shown the same connection, though on a more moderate scale. These events reveal something important about how financial systems react under stress. Oil shocks create two pressures at the same time. They increase inflation by pushing energy costs higher, and they also make it harder for central banks to respond aggressively because higher rates can slow economic activity further when economies are already under strain. That combination, rising inflation paired with limited policy flexibility, is exactly the type of environment where gold tends to perform strongly. It is not simply because gold reacts to inflation alone. Instead, it reacts to moments when confidence in monetary management begins to weaken. And right now, there are signs that a similar dynamic could be forming again in the global economy. The question is how quickly these forces might begin interacting with the shifts already taking place inside the financial system. That is where the next layer of this story becomes even more important.